Welcome to the Deep Dive, where we give you the shortcut to being the most informed person in the room. Our mission today is pretty laser-focused. We're cracking open the World Economic Forum's Chief Economists Outlook from September 2025, and we're going to pull out the essential insights. These are projections from the experts who are, guiding everyone through this incredibly disruptive time.
It's a real reality check, this report. The central finding, I think, is that the global economy is going through a profound transformation. I mean, this isn't just a typical cyclical downturn. It's marked by this sort of persistent short-term disruption, but it's layered on top of these big long-term structural changes. It just leads to so much uncertainty. So the outlook shows, resilience, but growth is really subdued. And the risks, well, the risks are all on the downside.
And the bottom line, it's delivered right up front. And it's pretty sobering. 72% of chief economists expect global conditions to weaken in the year ahead. So to understand that pessimism, we really need to focus on three major forces that are accelerating this new reality: geoeconomic fragmentation, currency volatility, and of course, the rapid pace of AI adoption. Okay, let's start with that dominant theme. Geoeconomic fragmentation. I mean, when 82% of respondents expect this trend to intensify, that tells you something, right? This is not just a passing trade spat, it's a systemic shift.
It absolutely is. And the U.S. is really at the center here, imposing these sweeping tariffs on a whole range of trading partners. But there's a really crucial data point that sort of complicates the story. Despite all that tension, global trade volumes actually increased by $300 billion in the first half of 2025.
Wait, how does that work? How can protectionism accelerate while global trade numbers are going up? That just seems completely contradictory.
It does, but it's the definition of a short-term adaptation that's masking a long-term realignment. Basically, firms are front-loading their shipments.
So rushing goods out before the tariffs hit.
Exactly, pulling future trade forward. But the underlying trend, that fragmentation, it's happening fast. We're already seeing Chinese exporters, for example, redirecting their entire supply chains away from the U.S. market. The whole architecture is being rebuilt.
So if trade is volatile, the currency markets are showing signs of, serious stress. Let's pivot to this dollar shock.
Yeah.
The U.S. dollar has depreciated by more than 10% since January. That's the steepest decline since 1973. And 78% of these economists expect it to weaken even further.
And this decline has these really critical two-sided implications. On one hand, for emerging economies, a weaker dollar is actually a welcome reprieve. It gives them more monetary policy flexibility.
A little breathing room.
Right. But on the other hand, for the U.S., domestically, the impact of those tariffs gets severely amplified. A weaker dollar makes all imports more expensive. So it's like a mechanism that fuels domestic inflation right alongside the protectionist barriers.
And speaking of mechanisms fueling uncertainty, let's talk about AI. Technology is clearly driving some tectonic shifts here. 68% of respondents now expect AI to become commercially disruptive within the next year. That's a huge jump from just 45% back in April. That feels imminent.
The disruption to business models is imminent, yes, but the payoff timeline, that's highly debated. So while there's this broad hope that AI will unleash faster productivity growth, only 40% of chief economists actually expect to see that productivity increase in the year ahead.
So the change comes before the benefit.
Perhaps. And that's also why experts are totally split on whether AI will cause, immediate labor market chaos or if its integration will be slow enough for us to manage.
That structural uncertainty really sets the stage perfectly for our regional scorecard. Let's move from these big global forces to specific geographies, because what stands out is just how much policy choices are driving these diverging paths, especially on inflation.
And we have to start with the U.S. Their policies are really shaping the global environment. The growth outlook there remains pretty subdued. 52% anticipate weak or very weak growth. But the defining feature is the inflation risk. 59% expect high inflation in the U.S. over the next year. That's a higher proportion than for any other region.
Okay, so this is where we need to connect the dots. The U.S. saw a rate cut in September, which suggests monetary loosening, but its inflation expectations are the highest. So if the weak dollar is already raising import costs, what is fiscal policy doing?
Well, fiscal policy is expected to become significantly more expansionary. The report points to a new fiscal package that's projected to add more than $3 trillion to the U.S. deficit over the next decade.
$3 trillion.
Yeah, so when you combine that kind of massive fiscal stimulus with tariffs and a weakening currency, you basically create this powerful domestic inflation engine.
Which makes the contrast with Europe really sharp. Europe's outlook is improving, right? 60% expect moderate or strong growth, and crucially, their inflation pressures are subdued. 44% expect low inflation.
And their policy aligns with that. 74% expect expansionary fiscal budgets. We see things like Germany's historic spending program, which is designed to stimulate growth without that immediate inflation headwind the U.S. is facing.
And then you have China, which is facing the complete opposite problem. They have strong growth expectations. 71% expect moderate or strong growth, but they have persistent deflationary risks. A staggering 93% expect low or very low inflation.
China's kind of trapped in a low-demand environment. 3/4 of economists expect both fiscal and monetary policy to loosen even further just to fight this. It's a really unique challenge.
And amidst all this effort to boost consumption, you shared an interesting detail about how Chinese households are reacting.
Right, they're reacting by saving, but in a non-traditional way. The housing market is slumping, there's economic uncertainty, so households are pouring record amounts of savings into the stock market.
Into assets, not spending.
Exactly, and that's why that stimulus isn't flowing into the economy as efficiently as hoped, and why they'll probably keep loosening policy.
Okay, shifting to the growth winners. The Middle East and North Africa, MENA, has the strongest outlook, with 37% expecting strong or very strong growth.
MENA is a key pocket of resilience. This growth is driven by, core resource expansion, but also successful diversification efforts and new AI-focused partnerships. They seem to be navigating this fragmentation better than a lot of mature markets.
But we can't talk about regional divergence without hitting on the direct negative side effects of U.S. policy. This is where fragmentation becomes very real for specific countries.
This is the cost of that withdrawal. For example, Japan now faces a new 15% tariff on all its imports into the U.S. South Asia, especially India, faces a massive 50% tariff on its exports.
50%? That could kill their manufacturing ambitions.
It could. And even sub-Saharan Africa is seeing new tariffs from 10 to 30%. These choices in one country directly reshape the economic prospects for huge parts of the world.
So if that's the short to medium-term story, let's zoom out to the long game, the structural disruption. This brings us back to trade and global value chains, or GVCs.
That's the highest rated area of long-term disruption. Those complex networks that define modern production, 70% of chief economists rate the disturbance to them as very high.
But what's pivotal is the permanence of this.
Yeah.
Is this a temporary shock, or is this really the new normal?
It's seen as the new normal. Nearly 2/3, 63%, expect this disruption to last for the long and very long term. This isn't just firms temporarily shifting things around. It's cementing new patterns of fragmentation permanently into the global economic infrastructure. The old model is over.
And this level of persistent volatility is clearly impacting the global architecture itself. The weakening of global institutions is a big concern.
A huge concern. 72% of economists see the disruption to these institutions as high or very high. The UN is restructuring, the WTO is basically being sidelined in these major trade disputes. And when those coordinating functions disappear, 63% anticipate systemic ripple effects, because that rules-based order that gave us decades of growth, it's dissolving.
Which leads us neatly to what you're calling the new fiscal strain. Global public debt topped $100 trillion in 2024. That number alone is staggering, but the key insight is where the risk is now concentrated.
This is maybe the most significant structural reversal in the report. For decades, when we talked about debt vulnerability, we were talking about developing nations. Now, 80% of chief economists expect debt vulnerabilities to grow specifically in advanced economies over the next year.
So the focus has completely flipped.
It's a fundamental change. The fiscal choices being made in the US, Europe, and Japan are now seen as the primary risks, not the debt problems of emerging markets.
So given all these risks, it's clear the global economy is splitting. The report details how growth pathways are just fundamentally diverging.
Yeah, you can basically categorize them by what they need. Advanced economies, they depend most heavily on intangible things. Access to technology and know-how, cited by 87%, and skills or talent, cited by 82%.
Human capital and innovation.
Exactly. Their growth is defined by that.
And for developing economies, it's an entirely different set of fundamentals.
Completely different. They rely most on hard inputs. Capital, highlighted by 93%, and resources or energy by 82%. In fact, access to finance is identified as the single biggest obstacle to business in key developing regions. So you have two different worlds, one focused on the innovation frontier, the other on fundamental investment.
And if we look at what's actively holding growth back, what's the biggest drag on the whole system?
Political instability and societal fragmentation. That stands out globally. It's cited by 68% for advanced economies and 48% for developing ones. But after that, the threats diverge. For advanced economies, it's trade barriers. For developing economies, it's weak or inflexible institutions.
So we have different needs, different threats, permanent structural shifts, and huge policy divergence. What's the final conclusion from the chief economists?
The conclusion is pretty hard to escape. 56% of them expect greater divergence between advanced and developing economies over the next 3 years. The global economy is literally splitting into two systems operating under different rules. A great divergence.
So this deep dive confirms it. We are transitioning to a new order defined by uncertainty, tariff shocks, and persistent risk. The cost of this retreat is already here.
And that cost is substantial. It extends way beyond just trade numbers. The report really emphasizes that cutting development aid and funding for global institutions is going to have major consequences.
And they were precise about those consequences. They believe if collaboration keeps declining, the most likely outcomes are increased global health risks, that's cited by 85%, and increased migration flows, cited by 77%. 75% also point to increased global security risks, and 69% expect more climate risks.
Which raises this critical trade-off, because at the same time fragmentation is accelerating, these same economists point to massive, untapped growth potential in places like sub-Saharan Africa and South Asia. That's where the world's next economic engines could be.
Which leaves us with this final thought for you. If reducing international collaboration directly increases severe global risks like health crises and mass migration, how essential is cooperation, not just for securing stability, but for unlocking these powerful new engines of growth that the entire world desperately needs?